Frank and Linda are sitting at their kitchen table in Scottsdale, Arizona. Frank is 73. Linda is 71. They did everything right. Frank spent 30 years at a manufacturing company. He contributed to his 401k every single year. When he retired, he rolled the whole account into a traditional IRA, just like his advisor told him to do. One morning in January, his phone rings. It's his advisor. "Frank, I need to let you know the IRS requires you to take a withdrawal this year. It's called a required minimum distribution. You have to take $41,509 from your IRA by December 31st. Frank pauses. "But I don't need that money right now." "Doesn't matter," his advisor says. "Once you turn 73, the government decides when you take it." Frank takes the withdrawal. He doesn't spend it. He parks it in a savings account. But by the time tax season arrives, that single forced withdrawal has cost him far more than he imagined, and not just an income tax. That's what this video is about, because what happened to Frank is already happening to millions of American retirees, and most of them never saw it coming. Quick note before we go further. I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always work with a qualified professional. Now, here is the part most people miss. That RMD didn't just get taxed once. It set off a chain reaction through 3 separate government systems, all at the same time. Let's walk through each one. The forced withdrawal machine. First, let's understand exactly how an RMD works, because the mechanics matter. An RMD, a required minimum distribution, is the minimum amount the IRS forces you to withdraw each year from your traditional IRA, your 401k, your 403b, or most other tax-deferred retirement accounts. Here's why. When you put money into those accounts, you got a tax break. You didn't pay taxes on it going in. The government was patient. But starting at age 73, they want their share, whether you're ready or not. The formula is simple. You take your account balance from December 31st of the prior year. Then you divide it by a number the IRS assigns based on your age. At age 73, that number is 26.5. So, if Frank has $800,000 in his IRA, his RMD is $30,189. If he has $1.2 million, that's $45,283. At $1.5 million, $56,604. Forced every single year. And that divisor shrinks every year. By age 80, the same $1.2 million balance forces a $59,000 withdrawal. By 85, it's $75,000. The older you get, the more they require you to take out. And if you miss your RMD, the penalty is 25% of the amount you should have taken on top of the income tax you still owe. Here's what most people assume at this point. An RMD is just a withdrawal. I move money from one account to another. I pay some income tax. That's all. Here's what's actually true, and this is exactly what Frank was about to discover. Once that RMD hits your tax return, it doesn't stay in one lane. It moves into 3 different government systems, all at the same time. Let's start with the one most retirees don't discover until it's already too late, your Medicare bill.
The first surprise wasn't the income tax. It was a letter from Social Security. It told Frank and Linda that their Medicare Part B premium was going up starting in 2 years. Not because of their health, not because of anything medical, because of their income. Here's how this works. Medicare charges a surcharge called IRMAA, the Income-Related Monthly Adjustment Amount. It applies to both Part B and Part D, your medical insurance and your prescription drug coverage. In 2025, the standard Part B premium is $185 a month. That's what most people pay. But cross certain income thresholds and that premium climbs sharply. For a single person, crossing $106,000 in income pushes your premium from $185 to $259 a month. For a married couple, the first cliff is at $212,000. And here's the part that blindsides people. IRMAA is a cliff, not a gradual slide. Going $1 over that threshold triggers the full surcharge for the entire year. There is no halfway. There is no partial adjustment. Let me make this real. A married couple whose RMD pushes them $5,000 over the first threshold pays an extra $2,105 per year in Medicare premiums from just $5,000 of extra income. That's a 42% Medicare hit before we even calculate a dollar of income tax. And the worst part? The bill you pay in 2025 is based on your tax return from 2023. Your RMD today is already being loaded into a clock that will raise your Medicare premiums 2 years from now. Most retirees never make that connection until it's too late. The highest IRMAA tier brings the Part B premium to $628.90 a month per person. For a couple, that's over $15,000 a year in Medicare premiums alone. So that's the second system. But there's a third, and this one is the one that truly shocks people because it quietly taxes something they assumed was the Social Security tax torpedo. Frank and Linda receive $38,000 per year in combined Social Security benefits. Before the RMD, that income was almost entirely tax-free. After the RMD, $26,450 of it became taxable. One forced withdrawal just converted $26,000 of protected income into taxable income. That is the Social Security tax torpedo. And here's how it works. The IRS uses a formula to determine how much of your Social Security is taxable. They call it combined income. You take your adjusted gross income, add any tax-exempt interest, and then add 50% of your Social Security benefits. If that combined income exceeds $32,000 for a married couple, up to 50% of your benefits become taxable. Cross $44,000 and up to 85% becomes taxable. For a single filer, those numbers are $25,000 and $34,000. Now here's what makes this a true trap. Those thresholds are never adjusted for inflation, not once. They were set in 1984 and 1993, and they're the exact same numbers today. Everything else has inflated: groceries, housing, Medicare premiums, but the income thresholds that determine whether your Social Security gets taxed, frozen. As a result, the share of retirees who now owe federal tax on their Social Security has grown from roughly 10% in the 1980s to nearly 50% today. Not because people got richer, because the threshold stayed put while everything around it moved. And this is where it gets mathematically painful. When your income falls inside the torpedo zone, each additional $1 of RMD income doesn't just add $1 to your taxable income. It adds 85 cents of Social Security on top of it because more of your benefits just became taxable. Total taxable income from $1 of RMD, $1.85. If you're in the 22% tax bracket, your real marginal rate on that RMD dollar is 40.7%, nearly double what you thought you were paying. Before I show you what happens when all three of these hit simultaneously, drop a comment right now. Have you already started taking RMDs, or are you still in the planning window? I read every single comment. Your answer tells me exactly what to cover next.
When all three hit at once. So let's put the whole picture together. Frank and Linda, both in their early 70s, $1.2 million in a traditional IRA, $38,000 in combined Social Security, no pension. Their RMD at age 74 is $47,059. That RMD pushes their combined income to $68,000. The IRS runs the Social Security taxation formula, and $26,450 of their Social Security benefits become taxable. Their total gross income is now over $73,000. They owe federal income tax they didn't expect to owe because one forced withdrawal didn't just add $47,000 of taxable income, it dragged $26,000 of protected Social Security income right into the taxable column alongside it. Now imagine their total income had crossed the IRMAA threshold because they also had some dividend income or a small capital gain. That same RMD year now triggers Medicare surcharges 2 years later, a bill that arrives in 2027 connected to an income year they barely remember. Here's the myth. An RMD is just a withdrawal. You take the money out, you pay some income tax, done. Here's the truth. One RMD dollar feeds 3 separate government systems simultaneously. It adds to your federal taxable income, it amplifies your Social Security taxation, turning $1 into $1.85 of taxable income in the torpedo zone, and it counts toward your MAGI that determines your Medicare IRMAA surcharges 2 years down the road. 3 tolls from one forced withdrawal. That is the cascade. And the most painful part? Frank and Linda are not wealthy people. They are middle-income retirees who saved carefully their entire working lives. That is exactly who this hits hardest, because the IRMAA threshold for a single filer starts at just $106,000. The Social Security torpedo kicks in at $32,000 for a married couple. These are not numbers for the ultra-rich. These are numbers that describe tens of millions of careful American savers. Here's the good news, and I want you to hear this clearly. The cascade is largely avoidable, but only if you act before age 73. The window is still open. There are 3 tools that can dramatically reduce or eliminate the cascade. All 3 are available to everyday retirees. None of them require anything exotic, but they all require acting before RMDs start. The first is Roth conversions during the low-income window. The years between when you retire and when RMDs begin are often the lowest income years of your entire retirement. No wages, Social Security possibly delayed, RMDs not yet started. Each dollar you convert from a traditional IRA to a Roth IRA in those years reduces the balance the IRS will later force out at a 40% effective rate. You pay 12 or 22 cents on the dollar now, you avoid 40 cents later, and the entire cascade that comes with it. The second tool is the qualified charitable distribution. If you are 70.5 years old and you give to charity, this changes everything. A QCD lets you send money directly from your IRA to a qualified charity, up to $108,000 per person in 2025. That transfer satisfies your RMD completely. And here's the key. The amount never appears in your adjusted gross income at all. It doesn't feed the Social Security torpedo. It doesn't count toward your IRMAA calculation 2 years down the road. It simply doesn't exist as income. For charitably inclined retirees, it is the single most powerful tax tool available. The third is strategic asset location. Keep your highest growth investments, stock index funds, equities, inside your Roth accounts where they grow tax-free with no future RMDs. Keep income-producing assets in your traditional accounts where they're shielded from current taxes. This naturally slows the growth of the traditional IRA balance that drives future RMDs. Smaller balance, smaller forced withdrawal, smaller cascade. None of these are complicated strategies. None of them require a Wall Street connection or a complex financial product. They're moves the tax code itself makes available to every person watching this video right now, but only before the clock runs out. Tax deferred didn't mean tax-free. It meant tax later, tax more, and tax everywhere, unless you act before the clock runs out. If you know someone who's 60 or older, a sibling, a friend, a neighbor, who has most of their retirement savings in a traditional IRA or 401k, share this video with them right now. The window they need to know about may be closing faster than they realize. Drop a comment below. Are you already taking RMDs, or